Thank you so much for listening to the Right Path to Retirement podcast with financial advisor Jimmy Lynn, president and founder of Right Path Wealth Management. You can find more information on the web at rightpathretirement.com. Again, that's rightpathretirement.com. My name is Jeff Miles, and Jimmy, one of the things I wanted to talk to you about today, as we talk about people's retirement planning and getting them ready to enjoy, what could be and should be the best time of their life. So there's an interesting article about how the stock market it's producing an indicator right now that doesn't necessarily happen all that often. And the 2024 stock market has produced an indicator that could prove positive for the rest of this year. And it says since 1957, the stock market has been up 10% in the first 100 days of the year, 18 different times. And when that happens, it continues to climb and averages. And this to me is one of the best parts of the story. This article says it averages 24% by the end of the year. Now, there is so many different factors when it comes to dealing with this and your retirement than we have in the past. But can we rely on a lot of these historic figures to kind of be accurate in looking ahead for the end of this year when it comes to people's retirement planning and those investments?
Yeah, I read that article as well, Jeff. And it's funny because every time we're recording one of these, it seems like we're coming off an all-time high on the yen.
40,000, right?
It is amazing. But, the number one rule in investing we always have to remember is past performance doesn't predict future results.
Right.
And I think this might be the case here. Now, when you dig into the numbers a little bit, it does show that the S&P ends up being 25% after getting this type of run up in the first quarter. But if you look at the numbers, since the internet's kind of been around and widely used, it's only gone up 3 times. There's only been 3 occasions where out of those 18 occasions where it really ran up. So I think the world that we're in now is much different than it was, from 1957 to the year 2000 with respect to things like the way investment is dealt with. There's so much artificial intelligence involved in trading. There's so many algorithms that are involved. There's a lot of day trading going on. There's meme stocks that can be manipulated. So there's a lot to uncover. I really like to kind of look at the fundamentals and the things that we really got to consider are, where is the economic growth in this country at? Where is inflation at? Where interest rates at? And that's all obviously tied together. But, inflation is still high. It's a lot less than it was last year, but we're still hovering over 3%. I think our target is 2%. Unemployment is lower, but the growth of our economy is not where it wants to be. I think we're at 1%, which was under what the predictions were. So there's a lot at play. We're also in the middle of a crazy election. I mean, a lot has gone on since we last spoke with regards to the election. We had an assassination attempt.
A lot has gone on.
We had the current president drop out and a new nominee. So there's a lot going on. I say all that, though, to say that it really comes back to what we've talked about in past episodes, right?
Yeah.
If you give every dollar a job and you put those dollars in different buckets, then you can really ride out any scenario that plays out. Because ultimately, I'm telling you about how I don't know if the previous trends of being up 10% for the rest of the year are going to play out or not. But do I believe in the market long term? Absolutely. I mean, history has shown that over the long term, the market does go up. So if you have those dollar bills that their job is for growth and you're going to utilize those funds in 5 and 10 years, I would be bullish on the S&P. But if you have those dollars that you're going to use in the next 6 months or even 2 years for a vacation, a down payment to a home, or just to fund your retirement income, that's where there's different strategies that you may want to employ where you can still get the upside of the S&P or any type of market index, but you can hedge with some of the downside risks. So it's important to look at the different options you have, because I wouldn't use the historical trends as something that we can rely on in this moment in time.
It's so interesting because I do think that when you look at the stock market, and I know that for some out there, and you've got some economists out there that they're saying that this is kind of, is this real? kind of growth in the stock market. And especially when you talk about the S&P 500, what is it like the Magnificent Seven kind of make up the bulk of all of the growth in the S&P 500? And is that enough to really bolster the entire S&P 500 when it comes to that growth? There might be questions from some people about, well, if one of those decides to take a turn, or if two of those might be in the same type of sector, it could signal a complete shift. Are there parts of that give you kind of a pause when it comes to jumping in on this idea that, hey, listen, it says here, according to this Motley Fool article, the stock market indicator has been 83% accurate since 1957, signals a big move in 2024. But because of the couple of things that, we've just talked about, the election cycle, which right now might be one of the most chaotic election cycles in the history of the United States, that has to have some sort of impact on, I'm not saying the actual stock market and how it's going to perform, but probably people's emotions and how they're looking at a lot of different things.
Yeah, I believe that to be the case as well. When you're looking at the S&P, you're absolutely right that it's being held up by the Magnificent Seven, and we have people on both sides that don't know where it's going to go. We have some analysts that say yes, the trends are accurate and it should go up at least 10% over the rest of the year, and we have other analysts from well-known organizations that think the S&P is going to drop 20%. So you really can't predict where it's going to go. And I don't think we've been in an environment like this where 7 companies are basically holding up and creating the profits and the growth. I don't think this is what happened in 1957 through 2000 again. So I wouldn't necessarily take those predictions. You look at it as a data point, but all the other things that you had mentioned have to be taken into consideration as well. And that's why, again, you have the money that is meant for growth. You can have that in the S&P, and anything that you want for more immediate use, there's other options for that. You have to diversify it, especially when you're going into retirement. I mean, if I'm talking to the 25-year-old Jeff, I would say, Jeff, go all in on the S&P 500.
Sure.
But, if you're a few years from retirement, you can't have that same mindset. You have to allocate. You have to protect yourself from the unpredictable, right? Because that's what we've seen over the past 3 years is the unpredictable. I mean, nobody thought we'd be at an all-time high. After COVID, I think everyone predicted things were just going to get worse. And here we are. So I would just say, take a cautious approach, but you don't necessarily sit on the sidelines. Like I said, there are ways to benefit from the growth while minimizing your risk. And I think that's an important thing to explore.
Here's an interesting thing, and this is more from the global perspective. And when I say global, not just the global as in, the Earth. I'm talking about the global perspective of the space-time continuum over the last 4 years, because COVID kind of shifted and threw everything on its head. And there's been so much, like you said, unpredictability for the past 4 years. I don't know that anybody could have predicted that in this election cycle, we would be going through some of the unpredictable things that have happened over just the last couple of months. When you look at that and you do look at, the stock market as, where you might park some of your investments and things like that, looking to the end of the year, obviously when November rolls around, in an election year, the outcome can make some moves with the stock market historically. When you look at how unpredictable it's been over the last, I would say, 24 months, and then we do have this election coming up, it does kind of bring a lot more of this idea of unpredictability for the next 6 months or so on what people's investments in the stock market's going to be like.
Right. And I think most people, they're more comfortable investing when there's stability.
Sure.
And what happened the last 2 weeks is not stability with regards to the election. I don't even, it doesn't matter what side of the political spectrum you sit on, as long as you have stability, as long as somebody is in place, it creates that stability where at least corporations know what they're dealing with. Whether it's a Republican or a Democrat, they always adjust. I mean, We're at an all-time high with regards to the S&P 500 with a Democratic president. Oftentimes, corporations prefer a Republican president because they're more business friendly.
Sure.
So my point is that companies will adjust. They just want stability. And so once we get the election through and we know who's going to lead the country, once we figure out exactly what the Fed is going to do with interest rates, that creates the stability. So that's why long term, I'm very bullish on the U.S. economy. But in the interim, I don't know if it's going to go up 10%. I don't know if it's going to go down 10%. So that's where you really want to focus on making sure that you don't take too much risk, and you have a plan in place in order to kind of, again, be prepared for all scenarios that could play out.
So as we're looking at, this story and the idea that you could see a 24% return on the stock market this year just due to historical data that says that if it's up, 10% in the first 100 days, then, it's going to go up. But we are in that unpredictable time. It's unstable right now. And when you want to kind of create some of that stability, you mentioned annuities a few minutes ago and fixed rate annuities. Talk a little bit about how those annuities, because, in the past, people have looked at annuities as kind of like, I don't know if I want to get into the annuity world. Talk about how it's a lot different now and how that could be almost a hedge against things like the stock market right now.
That's a great question. And you're right. The word annuity sometimes just becomes a dirty word. And it's just because historically, the way annuities came about, they essentially were a product sold by an insurance carrier where you can give them, $500,000 and they would promise you a lifetime stream of income. And if you got hit by a bus, then that money gets kept by the carrier and disappears essentially, right? So you really are betting on outliving the carrier. The annuities these days are meant to solve a lot of different problems. Some people have the problem of income. They want to make sure that they have a stream of income that's coming in because maybe they didn't come from a job where they have a government pension, right? So all they're relying on is Social Security. They did save a little money in 401k and they want to turn that into a lifetime stream of income. Annuity is a great solution for that. But there's other people that may have enough income and they want to really grow their assets so they can utilize it later in retirement, or if their goal is to pass it on to their heirs, they really want to grow their nest egg of retirement accounts, but they also don't want to have that market exposure because, again, everything we've talked about previously, the uncertainty and the volatility, it could go up, but it absolutely could go down. So a way to hedge against that is through something called a fixed index annuity. And that simply put is where you are not actually invested in the market, but the market is kind of a barometer to figure out how much growth you can get any given year. And like I said before, if the S&P 500 may go up 15%, you may have an annuity that gives you a cap of, say, 12%. Well, you can get 12%. You didn't get that 15%, so you lost out on 3%. But on the flip side, if the market were to go down 20%, you'd sit flat. You would not lose a dime. And so people like that comfort of having that upside potential, but not putting any of their assets at risk. And like I said before, oftentimes these type of accounts come with zero fees unless you add any type of features onto them.
When you talk about some of these fixed rate annuities specifically, how are they funded? Are they funded with qualified or non-qualified funds? Either or? How do people get into that? Yeah.
Either or. You can have qualified money. You can have non-qualified money. The most common way we do it with our clients is oftentimes they have money in a 401k or an IRA. It could be traditional IRA, it can be Roth IRA, but oftentimes it's just money that's been sitting there for a long time. And luckily they've gotten a lot of growth because, like we've been saying, the past 10, 15 years have been phenomenal for investors. And what a lot of them tell me is like, I think it's time to take some money off the table, right? Like oftentimes they don't want to be too greedy because they see that there is now volatility and they've done so well that why not take some of your risk off the table and do a rollover into one of these fixed index annuities that will still give you that potential growth, but now you've locked in what you've already grown, so you won't have any losses to that. So we do a ton of rollovers all the time with our clients, whether it be from their existing employer accounts or through IRAs that they may have outside of their employer.
And when it comes to these annuities, again, as you were talking about, it's kind of like when you're playing in Vegas. And look, I mean, you're in Vegas, right? So when you're playing in Vegas, it's kind of like you want to kind of know where that sweet spot of winning is, when you know when to walk away from the table and you're still up before you've gone too far. And I would say that many people, if you're sitting there at the craps table and all of a sudden the luck shifts on you, a lot of times you might be sitting there thinking, well, I just need another couple of hands to get back into the string of the luck being on my side. And you could end up going way too far in on something like that. Whereas a fixed rate annuity, as a complement, I guess you would say, to the stock market, but your gains can be, maybe they're a little bit more moderate, but at the same time, you feel more safety in that.
Right. And I can tell you this as a longtime Las Vegan, the way the losing players play are, I would say, the true gamblers is when they're on a hot streak, they continue to press and press and press and increase their bets. And we've seen too many stories about people losing it all because they were getting greedy and they wanted to increase those bets. On the flip side, we see the ones that they may have hit a hot streak. And what do? They don't necessarily have to leave the table because they want to be involved in the game. They want that opportunity to win. But what they do is they set some money aside. They lock in that money. They reduce their bet. And that is no different in the market, right? Now, most of us who've been invested diligently in the market, we're at an all-time high because the S&P is at an all-time high. When is it time to take your foot off the gas, still leave some assets, again, those dollars that are for long-term growth, but take some of that risk off the table, but put it in something that can still get you some growth. And so it's the same scenario in successful gambling. I don't know if we can ever call it successful gambling, right? But a successful strategy mirrors a successful strategy in investing is, again, making sure that you take some of those winnings, hedge your bet, and still get some growth, though. Because the last thing you want to do is just put it under your mattress, right? Because inflation is still a beast out there, but get some growth without that risk.
All right, very good. Well, listen, go to the website to get more information on how to set that appointment up at rightpathretirement.com. Once again, rightpathretirement.com. This is the Right Path to Retirement podcast with financial advisor Jimmy Lynn. He is the president and founder of Right Path Wealth Management. Jimmy, man, it is always a pleasure to get your insights on things like the stock market right now and what's going on with it, what we can look forward to for the next few months as we kind of wrap up 2024.
Perfect. Thank you, Jeff. It's a pleasure.
Make sure you subscribe and you have the notifications turned on to get more content from the Right Path to Retirement podcast. We will talk to you next time. Insurance products are offered through the insurance business Right Path Wealth Management. Right Path Wealth Management is also an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Right Path Wealth Management are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Right Path Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained by sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Right Path Wealth Management.